wants to be an accountant. My name is Letao Monye and I am your host. So, what we do on our show is that we get people with different jobs to get on this show and they want to be chartered accountants. We ask them a few questions and if they get them right, they get a chance to continue and go study at the University of Cape Town. Alright guys, now let's meet our contestants.
Hi everyone, my name is Wisani Dumela and I am a doctor at Live Long Hospital and I want to be a CASA.
Hi everyone, my name is Tabani Ndlovu. I come from Live It IT Technologies. I want to become CASA.
Hi everyone, I'm Tamam Toba and I'm a personal trainer at Health Fitness and I want to be a CASA.
Contestants, are you ready?
Yes.
Alright, let's get on to the first question. A consolidated statement of financial position should have all the assets and liabilities of a parent and subsidiary company included on it. Why is the $4,050,000 cost of the investment in the subsidiary not included on the consolidated statement of financial position? Ooh, this is not looking real good. Are you sure you guys want to be CASs? And the correct answer is, in the group financial statements, the investment cannot be shown as an investment as in the group, it's already accounted for as the net assets of the subsidiary are included in the group's assets and liabilities. So, in essence, it will be double counting the value of the subsidiary in the group's financial statement if the amount for the investment was included in the statement. So, it should rather be included in the parent's separate financial statements as the parent was investing in the subsidiary. Thank you. Alrighty, since our contestants failed to answer the previous question, we're going to direct the next question to Wisani. So, Wisani, this one is for you. Land is shown at a cost of 30 million on the subsidiary statement of financial position and is shown at a cost of 33,050,000 rand on the consolidated statement of financial position of the group. As it is the same piece of land, why does the amount differ when the group policy is not to revalue
Thank you for the
land?
question, Letabo. Regardless of whether the group's policy is to revalue or not, land should always be measured at cost with reference to the first one, SMEs. The cost of 30 million to the subsidiary was the cost at acquisition when the subsidiary purchased the land at the time they acquired the land. The 33,050,000 is the cost to the parent at the date of acquisition. Remembering that when a parent acquires the net assets of a subsidiary, it acquires them at fair value or market value, as if they were acquiring any other assets or liabilities in the general market. Hence, the 33,050,000 is the cost to the group on the consolidated financial statement.
Alright, thank you Wisani for your answer. Now, let us continue on to Given. So Given, here's your question. Goodwill is included in the consolidated statement of financial position, but not included in either the parent or subsidiary's separate statement of financial position. What is and how is it calculated? Why does it not appear on the separate financial
Thanks,
statement?
Letao, for giving me this opportunity to respond to the question that you asked me. First of all, in the question, there was an issue that deals with consolidated financial statements and the other issue that deals with separate financial statements. So now, consolidated financial statements are those financial statements that are prepared by a group. And we know that a group is made up by a parent company and a subsidiary company. Separate financial statements are the ones that each company, i.e. the parent company, will prepare and the subsidiary company will prepare. Therefore, goodwill is defined as all those future economic benefits that arise from the assets that cannot be separately recognized in the financial statements. So, the subsidiary cannot recognize goodwill because one, goodwill is an internal generated asset. And therefore, because the subsidiary cannot measure it, it completely fails the asset definition and cannot be presented in their financial statements. In the parent's financial statement, we cannot recognize goodwill because when the parent was acquiring the subsidiary, they bought an investment. And in that investment, the net asset value of the subsidiary must be revalued at their market price, which is what we call in accounting fair value. So when the parent was acquiring that investment, the money that they paid for the fair value of the net asset was not equal to those fair value. Therefore, there was this excess amount, which is what we call goodwill. Therefore, when we calculate goodwill, we'll say the amount that the parent company paid minus the net asset value that are measured at fair value for the subsidiary. The difference is goodwill. The group is the one that will recognize goodwill because with respect to the group, they are able to separately identify it as the difference that the parents paid and the market value of the net asset value of the subsidiary. Therefore, it makes sense that the group should recognize goodwill at the difference amount. Let's say that the net asset value that are measured at fair value for the parent, for the subsidiary is 100 Rand. And the investment amount that the parent bought for the investment is 150. Therefore, the different amount, the 50 Rand, should be goodwill. Therefore, the group should recognize goodwill at 50 Rand. And they will have to amortize the goodwill over a period of 10 years as stipulated by IFRS for SMEs.
Thank you, Given, for that rather long answer. And Kama, this next question is for you. The parent company's separate statement of financial position has a liability, loan from subsidiary PTY Ltd. Why is this liability not on the consolidated statement of financial position?
So, the subsidiary has lent the money to the parent company. What one has to ask themselves is, what is happening within the three parties? The three parties being the parent company, the subsidiary company, and the group as a whole. So with the parent company has received money from the subsidiary company. Therefore, the parent company will record a loan titled Loan from Subsidiary Company. With the subsidiary company expects the parent company to pay it back in the future. So the subsidiary company will record an asset, and this asset will be titled Loan Receivable from the parent company. At this moment, you have dealt with 2 out of the 3 parties. So what has happened with the groups? With regards to groups, a group comprises of a parent company and a subsidiary company. When companies within the group transact with each other, this is known as an intercompany transaction. So, when it comes to intercompany transactions, one has to ask themselves 2 questions. The first question being, has money come into the group or has money left the group? With this scenario, no money has come into the group or left the group. Instead, money is moving around the group amongst the parent company and the subsidiary company. The second question is, has the group transacted with the third party? The answer to this is that the group hasn't transacted with a third party. Instead, the group has transacted with itself. Now, when the group has transacted with itself, the value of the group hasn't increased or decreased, meaning that no transaction has occurred. Therefore, nothing should be recorded in the group's books or its financial statements. Thank you.
All right. Thank you, everybody, for watching our show. We've seen our contestant answer the questions correctly. And now we can safely say, everybody's getting a bursary! Yeah, join us next week and find out who is going to be an accountant.